Wesdome Gold Mines has been producing gold since 1987. The company has put no less than 5 gold mines into production. Wesdome is 100% Canadian-focused, with a pipeline of projects in various stages of development in the prolific gold regions in Quebec and Ontario. Duncan Middlemiss is Wesdome's president and CEO. He was born and raised in Kirkland Lake, Ontario. During his summer job at the local Kerr-Addison gold mine, he became fascinated with mining. Duncan Middlemiss on the recent discoveries in the Wesdome gold mines.
For the Q&A.
Well, let's go to the presentation, I think. It's been pre-recorded by Duncan Middlemiss, but afterwards he'll be live with us for the Q&A. So Duncan Middlemiss of Wesdome.
Hello, everybody. This is Duncan Middlemiss, the President and CEO of Wesdome Gold Mines, talking to you in order to present the company, Wesdome Gold Mines. During this presentation, I will be referring to forward-looking statements, and I would like to advise you of that. Wesdome has been a company which has been in existence for 30 years and now has seen a much different future than before. We've definitely got 3 building blocks in order to become Canada's next mid-tier gold producer. So essentially, we've got assets in great jurisdictions, Ontario and Quebec. We have low-risk expansion of the existing mines, and proven mining camps. So essentially, the mines are already built. It's a matter of expanding and optimizing what we have. And high grade. Our exploration has been able to uncover some fabulous grades at both operations, and we think that this is going to continue. So certainly proven building blocks to become a mid-tier gold producer. When we look corporately at the company, it's been, again, around for about 30 years. We've got 138 million shares outstanding. You can see the 52-week high and low. $15 is the high and $5.74 is the low. Good market capitalization, $1.9 billion. Certainly been on a very good trend over the last couple of years in terms of growth. Cash, as at the end of Q2, was $67 million Canadian. We have no debt. We have an active leasing program. However, we really have no debt. We've got a $45 million revolving line of credit, which is untapped. So certainly a lot of liquidity. In terms of analyst coverage, we have some very supportive analysts here in the Toronto area. So you can see all the analysts that are involved with the company and cover the company. And shareholding. The shareholding of the company currently is about 55% institutional and 45% retail. The largest institutional shareholder is the Van Eck funds, of course, the GDX and the GDXJ. They have about 11% of us currently. And again, very supportive, long holding shareholders. When we look at the jurisdiction of the company's assets, again, it's Ontario and Quebec. So really, the producing mine, which has really been around since about 1996 in commercial production, is Eagle River Mine. Eagle River Mine is a high-grade underground mine, which is located on the north shore of Lake Superior, pretty well right in the middle of the province of Ontario. And there you'll find, again, a high-grade underground mine, a mill which has a capacity of about 850 tons per day, and past production of 1.1 million ounces. Currently, the reserves are about 550,000 ounces, and the resources measured and indicated on 111,000 ounces. Right now, the Eagle River Mine is providing all the cash flow required for the company in order to conduct its advanced exploration at the Kiena Mine, which is located in Val-d'Or, Quebec, so asset number 2. So to the east of the Eagle River Mine, a short 7.5-hour drive. Essentially, Kiena Mine was built and operated by Placer Dome and operated until 1997 under that company and then sold to the juniors. Very good past production, 1.75 million ounces. Very good global resource on the property. The property is quite large. It currently has a fully permitted mill, mine, tailings area. Everything at the Kiena Mine for production is ready to go. The only thing we need to do is declare some reserves based on a positive PFS, which is upcoming, and get this mine back into production, which we see to be in a fairly short time frame. I would think sort of end of the first half of 2021, and very low capex. So really, it's a very good growth story for us. We'll be able to diversify our asset base and get another operation into production. The third asset we have is located in Western Ontario, is the Moss Lake. Moss Lake is a large open pittable resource right now. It's got almost 4 million ounces of indicated and inferred resources. Currently, it's a project which is very torquey with the price of gold. So in terms of a Canadian gold price right now, at $2,500 an ounce Canadian, this project becomes very viable. We need to do more assessment here. It's been on the back burner essentially since number one, we've been optimizing Eagle River. We've doubled our production there in the last 4 years, and also trying to get Kiena up to a restart position. So that's really been the focus of the company for now. As things evolve, Moss Lake certainly will become more of a focus for the company. In terms of the highlights for the company over the last little while, you can see a nice growth curve here. So really the high-grade brownfields discovery. So I think that really when we look at this company and what's been able to be achieved here, it's sort of a two-part process. One is optimizing the existing operations. So we've been able to solidify production, secure free cash flow from the Eagle River mine. We then use this cash flow in order to develop our advanced exploration project, the Kiena mine, and continue a very, I'd say, aggressive exploration program throughout our properties. So 2016 to 2018, we were certainly fortunate to discover the 303 lens at the Eagle River mine. Very high-grade lens, over 30 grams. It's been able to bring our production from sort of the 50,000 ounce sort of status quo up to this year's guidance, which is 90 to 100,000 ounces. Over at the Kiena mine, again, we've been very fortunate to find a very high-grade deposit called the A zone, very different from whatever kind of mineralization existed there before. It's a quartz vein with high-grade visible gold within it. So very different from, really the 4.5 gram historical production. 2018 to 2020, pardon me, the Eagle River was able to discover some new mineralization outside the mine, but actually links with mineralization within the mine. So it's not that far away. It's able to add another workplace for us in the midterm, I think. Again, very high grade, and it's called the Falcon Zone. So again, another potential catalyst for us to grow our production at the Eagle River. And also in the last little while, we've been able to expand our A zone and our lower BC zone. So at the Kiena. So a lot of good results coming from our exploration program, which again is fully funded by our production at the Eagle. So really low risk expansion at Eagle. We've seen a lot of really good improvements in terms of our mining practices, dilution controls improved substantially. Again, investment into exploration has made this operation a lot more sustainable. We've had reserve growth from essentially 400,000 ounces up to 550,000 ounces. So essentially, we are expanding mine life. We're really getting a lot of better optionality for the property. Again, gold production has increased by about 55% since 2017. Cash costs have declined by 25% over the same period. And I think the team is really what I call a brownfields optimization team. So really, both of our assets are brownfields. And I think that the optimization at Eagle has allowed us to really focus in at Kiena also and to bring that asset forward. Also, in terms of investability, we really haven't put out any shares in terms of raising funds. The second quarter of 2016 was the last bought deal, a $17 million bought deal. Our fully diluted share count has only increased by 4.5% since that period. We believe that the Kiena Restart project can be fully funded with internal cash. As I mentioned before, the company at the end of the second quarter currently has about $67 million in the bank and an untapped $45 million revolving line of credit. So essentially, we are very well poised for that. The CapEx estimated in the recent PEA was $35 million for Kiena. Again, this is a fully built out mine. Really, the focus would be on underground mine development in order to access the high-grade A zone. And we're certainly well positioned to pursue select strategic investments, especially around our core assets, so Kiena and Eagle. When we look at Eagle, I mentioned the reserve growth that we've seen over the last couple of years. You can also see the grade here. So 550,000 ounces with a head grade of 14.4 grams. So essentially, it's a narrow vein, high grade mine. With the advent of the Falcon zones off to the west, I think that the mine will be able to start churning out some more production as we look forward. I would say that would be a midterm solution for us. The mill capacity is about 800 tons a day of Eagle ore. Currently, the mine is doing about 500 tons a day. So there are opportunities for us to expand production even at Eagle. You can see the resources here also. We've got 111,000 ounces of measured and indicated at 9 grams. The inferred portion is almost 160,000 ounces at 12.3. So certainly, I think the future is bright for us in order to continue the reserve growth and replacement at Eagle River. You can see the 2020 programs just below a nice piece of the Eagle ore here. You can see a nice quartz vein with some visible gold through it. Very typical for what we see. Sustaining capital really hasn't changed that much year over year, about $17 million. Exploration, again, is aggressive, around $7 million. Pre-COVID, we had 7 drills on site, 2 on surface, 5 underground. Currently, we had to back that off a bit in order to allow for social distancing in the camp. However, we're starting to layer the drills back in. We now have 3 drills underground and 1 on surface. So we look forward to resuming 100% of our planned exploration. In terms of our recent results, the second quarter was a strong quarter. Again, we've guided the market 90 to 100,000 ounces. Essentially, we did 25,000 ounces of production in the first quarter. We did about 25,000 ounces in the second quarter. So we're really on pace right now to meet our guidance. Not an issue there. You can see the grades produced by Eagle River. I mean, it's a very high-grade Torquay mine. In the year-to-date grade is 15.8 grams. So, just for reference, that's over half an ounce. So certainly very good grades. And you can see here the average realized price per ounce for year-to-date. I mean, $2,257 Canadian. Just to put that into context, we budgeted 2020 at $1,885 Canadian. So we're well north of where we had expected to be in terms of cash flow generation and our abilities to fund fully the Kiena restart. So based again upon a positive pre-feasibility study, which we expect to be completed in 2021, first half. Here's a nice long section of the Eagle River in-mine exploration. You can see the various zones, all color-coded there. I would point you to the upper left corner, the Falcon zone. Typically, the historic mine was everything within the red dashed line confines, the diorite. So the Falcon zone is different because it's out in the sort of surrounding volcanics. The nice thing I would say about this is we have a huge regional trend. We've got probably about 20 kilometers of strike length of these shear zones in order to explore. We're just starting to do that now. The focus for this company for the last 3 years, I would say, is really sort of the sustainability and ensuring the mine had a good production plan for 5 to 8 years ahead of it, which we now have. I think that there's certainly optimization, which is ongoing. However, we now see, let's start to layer in some of these regional exploration plays. And obviously, Falcon Zone didn't get too far out of the mine, only about 300 meters, and it actually joins back in with the mine. So very prospective. One of the high-grade zones that I referenced before, back in 2018, we had found this very high-grade shoot called the 303 lens. It's part of the 300 series, which is furthest to the north. These are all parallel lenses within the mine. So this is the furthest one north. This is a really exciting ore body, very high grade. You can see some of the intercepts here, 49.1 grams over 6.4 core length, and 128 grams over 5 meters. Certainly a real difference maker here. We've currently mined out from 925 up to 750 meters below depth. And now really the chute, I'll call it, is open at depth. So we've got it defined all the way down to 1,300 meters. And like many Abitibi deposits, very deep-seated, we think, continues to go at depth. And Currently, the ramp is down around 1,100 meters, so we could certainly access almost 200 meters of this high-grade chute. So very excited about that, and really secures production for the I'd say, near to mid-term of the mine. Here's a top-down view of the mine diorite. You can see the parallel zones in here. So what you see in red at the bottom part of that gray area is the 8 zone. And 8 zone was mined historically for the last 25 years, and there's still reserves on it. However, since around 2013 and 14, again, there's been, the discovery of these parallel zones to the north. And I would have to say that, largely the company was very underexplored. And it was only at that point that they were actually trying to do some exploration deeper on the 8 zone that they had to do a drift to the north, and ended up discovering this. So essentially, this has brought a whole new feature for this mine, whole new life, because essentially we do have other mineralization to look at in parallel fashion. And these parallel zones, they extend outside the diorite also. So there's a lot of potential here. The Falcon zone is just outside the diorite in the volcanics along this trend. Speaking of the Falcon, this is really what we've been able to discover. So again, found from surface drilling early, so you can define, the mineralization from surface down to about 400 meters. And then after that, it gets a little more difficult on a surface rig. We had established some really, I'd say, important underground drill platforms at the Eagle River over the last couple of years. And one of them was located on the 772 level, where we have since been able to define this down plunge of the mineralization. So as we know it now, the mineralization we discovered at surface 300 meters outside of the mine diorite now actually connects with the mineralization within the mine. That's pretty exciting for a couple of reasons. Number one, it's very high grade. Number two, we've got really a kilometer of plunge length to really look at it in terms of the chute. And number three, very close to infrastructure. So you can see some of the drifts over here. We're probably only 100, 150 meters away. So we need to further define this chute in order to bring in production. As I mentioned before, we're currently doing about 500 tons a day. This would be certainly an additional workplace that we could layer in some additional tons. So every additional high-grade ton that we can bring in is going to start to grow the capacity in terms of production at Eagle River. I mentioned the regional trend. This is a nice plan view here. What you can see is the Eagle River mine, which is that pink diorite, which is the intrusive there. You can see essentially a 20-kilometer trend here, and really these shear zones, these quartz shear zones go throughout this. And we've got known gold anomalies all throughout that really have never been properly assessed or defined. And so we are now at this point where we've secured the future of the mine. In terms of our other asset, again, Kiena, it's our advanced exploration asset. Again, Keena's fully built, fully permitted, 2,000 ton per day mill. The shaft goes down 930 meters. It's really ready to get into production based on another positive economic study. Again, we had performed a PEA earlier in the year. In terms of our land position in Val-d'Or and on the Kiena property, it's extensive. We've got 65 square kilometers to explore, all sorts of known resources on it. Again, we've got 1.6 million ounces of global resource on it, indicated and inferred ounces, of course. A very prolific past gold production, current gold production. Eldorado has got an operation right here, the Lamaque mine, which is in production and doing very well also. So I think the future is bright for this area, but I also think the future is very bright for the Kiena mine, the property. Currently, we've probably explored about 2 square kilometers in support of the Kiena restart here. However, we have existing resources and past producers all throughout the property. When we look at the resources, what we can see here, the A zone, which is the upper left here, you can see the grades here associated with the A zone. So the last resource that we put out was towards the end of 2019. You can see the indicated portion, 405,000 ounces at a head grade of 18.55 grams. Pretty spectacular. The inferred portion, 332,000 ounces at a head grade of 15.2 grams. So again, very high grade regime, something very different. Remember, this was a 4.5 gram head grade mine. Good production, 1.75 million ounces. This is a very different structure though. This is lots of visible gold in it. It's a quartz vein. It's nothing like they mined here before. In terms of what we have blocked out here with this nice red box is really the resources we looked at for the PEA. And so really we incorporated all the A zone, of course, because of those grades, but there are existing resources proximal to the mining operation. So the S50, the BC zones, and the South zone were incorporated for what can be additive to the economics of this restart plan. So essentially, we've incorporated almost 850,000 ounces, again, 450,000, the indicated category, and almost 400,000 of the inferred. And again, as you can see over here, the global resources, almost 1.6 million ounces on the property. So indicated 788,000 ounces and inferred about 800,000 ounces. Highlights of the Kiena Complex PEA, I mean, pretty compelling after-tax IRR of 102%. All-in sustaining costs of $674 per ounce. Operating costs, $163 per ton Canadian. After-tax NPV on a discount rate of 5% is $416 million Canadian. Again, we believe this to be a very conservative PEA. The goal for the company is to get a second asset started. And upon that, once we've crossed that milestone, we'll be able to fully assess the regional exploration potential that we have on that property. First things first, let's get the mine into production, and then we'll start to do a very fulsome exploration program on that 65 square kilometer package that we have. We're well funded. We're adding money to the bank as we speak. Gold price is very supportive in terms of Canadian funds. We're north of $2,500 Canadian per ounce. So it certainly bodes well for having the capabilities of a restart here. In terms of some of the parameters we've got embedded in the PEA, we've used a gold price of $2,016 an ounce, or $15.32 US. You can see 76 cent dollars. So really looking at this, I'd say fairly conservative parameters. The discount rate of 5% we believe is very applicable to this project. The mill is built, the shaft is sunk, the infrastructure is there. We think that there's certainly a much lower level of risk on this restart plan. So essentially, it's off to another mineral resource estimate, probably the fourth quarter of this year. On the back of that, it's going to be a pre-feasibility study, which will be really the focus of this is to try to, for the mineral resource, is to convert all the inferred into indicated so that we can employ it in the PFS. And at that point, get a PFS out that will hopefully show a positive return, which I'm sure will. In terms of the forecasted production, I do view this as a fairly conservative production, but we do get up to that 100,000 ounces. So this is the mid-tier scenario. So we've got Eagle almost to 100,000 ounces and probably growing. Kiena Mine is up to 100,000 ounces. So based on that, here's a historic producer for many years who really was about a 50,000 ounce producer, all of a sudden getting to the 200,000 and north of 200,000 ounce production. So very exciting times for us. We do see us being able to sort of hit that mid-tier status. Sensitivity on Kiena, really the project is sensitive to exchange and to gold price, not very sensitive to OPEX or CAPEX. So it's a good project. Our next steps in order to support the PFS, we've got a lot of definition drilling going on in order to convert again inferred into indicated. Metallurgical test work and a lot of the environmental work needs to be done. So let's talk about Moss Lake quickly and what we've been able to develop here. We've got additional land position that we added in 2016. We've got a nice 8-kilometer trend that we've been able to define. However, our focus right now is number one, optimization of the Eagle River to keep the Eagle River operation strong and cash flowing. And 1B obviously is to get the Kiena Mine up and running and de-risk the company significantly with a second producing asset. When we look at what's been able to be a key catalyst for the development of this company, it's been exploration. And really the exploration done prior, it just wasn't funded enough. And we could see that the geological potential of both our properties, all three of them really, was huge. And it just really needed to be assessed. And so in order to do that, we've been able to fund the exploration organically. And just in summary, I'd like to just stress it is a low-risk situation. I mean, both the operating mine and the advanced exploration project are both built out. Permitted, really at Eagle, we were looking at optimization of existing. At Kena, we're now adding to the indicated resource and starting to get a foothold there in order to get a production scenario. And highly executable. I mean, obviously, we have the capabilities financially to restart Kena at $35 million pre-production and continue along a good growth path. We've certainly got a good team which is able to do this. So, with that, I'd like to thank everybody for listening, and I'd like to turn it over to questions.
And Duncan, Duncan Middlemiss is now joining us live for questions. Good day, Mr. Middlemiss.
Hi, how you doing?
I'm good. How are you?
Fantastic.
Okay. I understand you had this summer job in a local mine when you were a student. Is that where the spark was lit?
Yeah, absolutely. My father was a radiologist. I think I was supposed to be a doctor, but I got involved with gold and underground mining and just really was very interesting to me.
So you thought, let's stick to that?
Yeah. Been a good choice.
Okay, good to hear. We've got some questions coming in from Twitter and on YouTube. If you have any questions, use the hashtag DD2020 or ask your questions on YouTube. Willem, you had selected some.
Yeah, at first I would like to show the graph of Wesdome Gold Mines. As said, we are investors. Actually, we hold shares in all presenting companies today. And if we look at the graph up to date, year to date, 21%. That's not an incredible result, but if we look at the 5-year chart, Wesdome is up over 1,000%, and it shows it has been a very good investment for us and for many investors. And if we go to the questions, Duncan, one of the questions was, what are the top 3 risks for Wesdome? And then we don't talk about a lower gold price. So operational risk, other risks.
Yeah, you're always going to have an element of operational risk. However, I think that really our ground conditions are stable. I think the ore that we have is well understood. I mean, the more we drill, the more we know. It's a matter of de-risking everything. I think really right now what we're going to see, as I do believe we are coming into a bit of a super cycle, it's going to be the acquisition and retention of talent. It's getting pretty thin out there. Unfortunately, mining has been an industry which has been unable to attract a lot of new sort of bright students into it. I think it somehow gets erroneously viewed as sort of a knuckle dragging event, if you know what I mean. So I think that we still have to do our job in trying to recruit and attract good people into mining. So I really do see that being one of the bigger issues in order to move forward. Other than that, I mean, we're very lucky. We're in a great jurisdiction, both Ontario and Quebec. Yeah. You probably couldn't get better.
Is it getting more difficult for you to attract younger people, the newer generation?
Yeah, it is. Being that there's not as many young people into mining, so the numbers are down, I would say. But the ones that are in there, they're very good, but they're very sought after. And there's guys like me who are pushing 60 now, and it's time to get some new blood into the organizations. And I think that's a challenge for everybody right now.
Does that mean you have to pay higher salaries?
It's competitive, yeah. Definitely, it is competitive. So there is some cost pressure on that. We haven't seen a large amount of cost pressure. I do recall back in 2005 and 6 when all the commodities were going pretty crazy, and there was a real cost escalation. We haven't seen that as of yet.
No. Back to the questions. There are some questions regarding M&A. There are not that many independent gold producers of your size, your 1.7 billion market cap. Do you expect to stay independent?
Yes. We've actually just onboarded a vice president of corporate development. I mean, we don't make a secret of it. The Kena Mill's got about a 2,000 ton per day capacity. I think there's a lot of interesting projects. I call them orphan projects in around the Kena mine, say 200 kilometer radius, which I think in the big picture would be more shovel ready than some of our far field resources on the Kena property. So in terms of timelines, it would probably be advantageous for us to look for a truckable, higher grade underground resource. I think we'd like to grow, certainly. I think we've got a good team together, and certainly with Kena and Eagle both in operation, we'll be strong financially and able to have different options.
So we could expect some buying activity from your side to grow into a larger company?
Yes.
That's good. Even this year?
That's a little early. We'll see. You know what? When opportunity knocks, you have to answer the door. So but we're certainly just trying to get more intelligent about the process and have more formalized.
If we look at the industry as a whole, we see that all major gold producers have difficulty to maintain their production levels, and we could say we passed peak gold production. Is this a problem for the whole industry?
Yeah, I mean, generally we see the the average grade of deposits worldwide going down. I mean, let's face it, all the great high grade fantastic deposits, which were easier to find, have now been found and mined. That definitely is going to put a challenge on it, but it's also going to likely add to the price of gold. I think you're going to start to see a little bit of the scarcity factor come in there.
Yeah, what are you hearing from analysts and other experts from the industry about the gold price and the fundamentals for gold? Even Warren Buffett is now promoting buying into gold mines. This could take some serious, length of time, this bull market.
Yeah, I think just the economic stimulus being provided by the governments. I mean, I think that you can't just continue to print money without an effect here, and I think one of the effects is obviously going to be a bit of a flight for security. If you just keep printing money, it's going to become less and less valuable. I think we're seeing that. Has
the mood changed since Corona hit, in that respect?
I think so. I think it has. I think what we're seeing is continued stimulus from the governments.
Okay, time's up, I'm afraid. Thank you for joining us, Mr. Middlemiss, President and CEO of Wesdome. Thank you.
Thank you.
Thank you very much.